This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest, your daily breakdown of news that matters. I'm Christine Stewart, and these are your headlines for today, May 20th. First up, a new study shows us just how much the shift to remote work has driven up housing prices. The National Bureau of Economic Research estimates that half of the spike in prices during the pandemic is because so many people are working from home. So what does that mean for the housing market going forward? Our Mike Savino has more.
Everywhere people want more space because everywhere more people are working remotely.
As companies shifted to remote work during the pandemic, families were scrambling for more room. People still wanted dedicated office space, and for some, that meant the need for a bigger home. Economists knew that this was a factor in home prices going up, but the authors of a new study were surprised just how big that role was.
Just how important that feature was in the data that we're all just trying to get more housing, and how much that explains the house price appreciation. That to me was very surprising.
The study from the National Bureau of Economic Statistics says that home prices have gone up by nearly 24% since the start of 2020, and that a little more than half of that jump is because of remote workers. Earlier this week, a separate study also found that home prices in suburban areas rose faster than in cities. That's in part because remote workers have more flexibility and they're opting for more space and warmer climates.
So those kind of moves that we're seeing people take perhaps weren't feasible without taking a significant hit in your career.
The NBES study didn't forecast the future of the housing market. Its authors did say that if companies start calling their workers back to the office, the housing market could cool back down.
And then on the other hand, we decide actually this remote stuff is really great, we should do much more of it. It will be a much more positive forecast for the housing market, right? So
I'm Mike Savino for the Mortgage News Network.
ARM loans might be a saving grace for borrowers who recently purchased a home, but it comes with risks. According to Redfin, the typical homebuyer could save an estimated $15,582 over 5 years by taking out an ARM. That's the latest savings in the dollar volume for ARM holders since at least 2015. ARM loans have been rising in popularity as mortgage rates surge at their fastest pace in decades. Scores of borrowers were drawn to ARMs in the early 2000s due to their lowest initial teaser rates. That became problematic when rates reset higher and many buyers could no longer afford their monthly payments. Today, banks do more due diligence to determine whether buyers will be able to cover the increased costs when the loan resets. Realtor.com says that the median rent price has hit over $1,800 in April. The relentless rise in the cost of rent continued for the 14th consecutive month. At the same time, landlords are seeing their yields decrease 72%. Adam reported that gross returns are dropping in 2/3 of the markets where homes typically sell for less than $250,000. The downturn in single-family rental yields comes as prices that landlords must pay to buy their properties are rising faster than rents.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.